Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. This webcast series is all about using options for income, and for some traders, they use a cycle of income option strategies known as the wheel strategy. And today we're going to be talking about the trade that puts the wheel strategy into motion. We're going to be talking through how a trader might master the kind of fine art of selling puts. So I think this is going to be a really good discussion. If you're not familiar with the wheel strategy, we'll make sure that we explain what that is before we go put it into practice. But a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody. It's already chatting in. Great to see so many familiar names out there in YouTube. Hello there, Paul and David, Eva, Jay Richardson, Josh. I've seen a bunch of other people here, Will and Lawrence and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the show is concluded, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. We would love to have you here in the live stream audience. And as a treat for my live stream audience members, my very good friend, longtime peer, Brent Moore is going to be hanging out in the chats with us. Brent's going to be addressing any questions that I can't get to. Thanks for having my back there, Brent. And Brent and I would like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters there. It's the best place to connect with your favorite presenters. And you can find Brent there at Brent Moore CS. You can find me on X at Cameron May CS. But let's get into this discussion of putting the wheel into motion by selling puts, the wheel strategy. Now, as we dive into it, of course, we need to be aware of the risks associated with trading and investing. Risks are real, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so with that accomplished, let's set an agenda for the day's discussion. The first thing we're going to do is take a quick peek at our existing positions. So we have some covered calls, we have some short puts. Some of those need some attention today, so we're going to go have a look at those example trades. Then we'll take a quick peek at the markets. I don't think we're going to spend a lot of time on that because the markets just keep doing this. We'll see if that changes sometime in the future, but not necessarily at the moment. But in any case, then we're going to plan and place a new trade, selling a cash secured put to start this wheel strategy into effect. We'll go through what a wheel strategy is, how we might select stocks and select puts. We'll do an example trade before we're done. So that's how we're going to proceed. So let's go right to the Thinkorswim desktop trading software platform. And here are our existing positions. Apple has actually changed since last time. You'll notice with several of these, it's neither a covered call nor a short put. We just have a long stock position because these previously were covered calls and the calls have just expired. So with Apple, that's what's happened. Let's go look at the chart of Apple. This one actually started off as a wheel strategy. For some, this can be one of the things that can be appealing about this strategy. The income can sometimes boost performance of stocks that are doing well. At other times, it may just help to offset some of the unrealized losses of struggling stocks. And this falls more in that latter category. So we started off this trade this is back in early March. Sold a put. The put was assigned. We collected a $3 premium, assigned the shares at $235. And boy, those shares really collapsed in value, and they've recovered to some extent. So had we just sold that put and held the stock position, this is where that trader might be. So we initiated a trade here. Stock's gone down to there. Not great performance, right? Well, along the way, though, let me just remove this drawing. There we go. Along the way, we've collected some additional premium, and this is part of a wheel strategy. If a put is assigned, a short put is assigned, then that trader, as the owner of shares, might sell covered call positions against those shares. And that's what we've done on a number of occasions. Sold a call here, sold a call here, here, and here. 6 call premiums collected. Those have all been closed for a profit, and the net between the initial put and all the call premiums that we've collected has brought in about $10.52, setting fees aside, $10.52 per share. So our break even has moved from up here to down here. So really, with where the shares are right now, not terribly far below break even. It's a trade that's still net underwater, but not nearly as far underwater as maybe a trader who had just purchased the shares or been assigned the shares and then just held those. So now, it doesn't always work out optimally, and I would not describe this scenario as an optimal outcome. It's maybe a less unprofitable outcome, but we just need to be aware of both sides of any strategy, the potential pros and the cons. Now, this leaves us with stock shares, and there is an earnings announcement right around the corner for Apple. So we're not going to sell another covered call just now. We're going to hold through that earnings. Some traders just prefer not to hold covered calls over earnings. Limited upside, very large downside. Now, some don't mind, but we're just going to leave that one the way it is. Abbott and GILD, these are trades that we placed. They're actually doing just fine with this. This is a covered call. Bought the shares, sold the 130 call. The preference here is for the stock to be below 130 as we move toward the 15th of August. Right now it's at 120, actually about 126, actually on the nose. So, yep, that's actually doing fine. We're going to leave that one alone. With GILD, this is a put that we sold way out of the money. Sold the $80 put. We just want the stock to be above $80 as we move forward in time. And the stock right now is at $113. Still about $34 out of the money. Sold this originally for $310. It's now at $190. We have an order to get us out if we happen to be able to exit with a 50% gain here, 50% of our $310. So that one's working. We're going to let that one continue to work. With NEE, this one I think needs some attention today. So let's have a look at NEE. We have 200 shares. Here's the history of NEE. This is one where we sold a put. We were assigned the shares, so we kept the original premium for a realized gain on the premium, assigned the shares at $72.50, and we've just held that position until recently. We sold some calls against that position for another $55 profit, 55 cents per share. Did not sell a call over this earnings announcement, and this is what can happen sometimes with earnings. Earnings have gone against this position. Now, net between the premiums collected and the price paid for the shares, we're still profitable on this trade overall. Purchased the shares for 72.5. They're now worth 71 and change, so down a little bit. But we've collected over $2 in realized gains now in premiums. So net not doing too badly. Not a huge winner overall. But the trader here might need to decide, what are they going to do? If they think the stock is just going to continue to go down, maybe they sell the shares. Just be done with the trade. Small profit, over. Well, oh yeah, and somebody says, did somebody ask about the boxes and things on this chart? I just draw those in, just as visual reference points so that we can see the details of the trade. Well, let's say that our trader here has noted, NEE has been coming down, but it's maybe settling in right along a trend line. And it seems like the stock has a strong tendency to move up sharply and then back sharply, up sharply and back sharply, up sharply and back sharply. So maybe the trader is concerned, we could break and continue lower, but selling now, maybe they conclude that it seems more technically likely that we're going to advance from here than fall back. So let's retain ownership of the shares under that premise, but sell a call. Where can we sell a call? Maybe up here at this previous resistance. I don't know what we can get for $75 call, but let's see. Let's go to our trade tab. Let's go out to the 15th of August, first of all, and see if there's something. It looks like it's only about 36 to 40 cents. Maybe some traders would be okay with that. We have lots of things, at least a few, expiring at that time frame, and we're going to be adding another one at that time frame today. Let's go out maybe to the next monthly expiration. Look at that, $75 call, and that looks like that might be able to bring in a little bit over $1. How about we do that one? So we have 200 shares. Let's click on our bid price and let's sell 2 contracts. And how about Naturals at 107, the mids at 109. Let's just leave it right at 109. Pardon me, at 107. Just in the interest of trying to get a quicker fill. Still a possibility it might not fill at all. But we're going to click confirm and send and sell those two contracts, the $75 calls for 107. And just bear in mind that there are also commissions to be paid on this trade. Let's send that off and let that work. I think that's pretty likely to fill here pretty quickly. There it is. You actually sold it for 112. Okay. So now the trader has a preference for the stock to continue, well, actually to reverse and climb, but just we need to be aware that we have an obligation now to potentially sell our shares up at 75. If that contract gets assigned, we wind up selling the shares for $2.50 more than we paid, plus the premiums already collected, plus the one we just collected. That's our best case outcome. Now, if the trade starts to fall, let's put a note down here. We will consider closing. I don't need to capitalize that. Let's consider closing if support breaks. We could put in an order to automate that. I'm going to just make a plan to do it so we can get it on camera if we decide to close that out at a future date. Ted says, please use walk limit orders to demonstrate. And Ted, I'm not going to be doing that today. However, I have done that in the past. So if you have an interest in specific topics like that, one thing that I would suggest someone do is if you're new to these webcasts, either maybe this is your first one or just recently started, if you haven't subscribed to our Trader Talks channel just yet, do that right now. Subscribing to our YouTube channel only takes a second. You go right down to the lower right-hand corner, click on the subscribe button. But that's where we house all of our previous webcasts where we've covered things such as the walk limit order. So what you can do is go here and do a search for like walk limit. I actually did one where I think my thumbnail said walk limit orders are here, and anyway, I covered that. But yeah, this is where we'd access the playlist for previous webcasts, and we can join the live streams right there. Very good. So let's go on with our positions here. So we've added a call to that position. It's sitting down here under unallocated. We can come down here. You can see that sort of floating there by itself. Let's move it up to our covered calls. Right click, move to group, covered calls and short puts. Now it's up here, combined with the original stock position. All right, so now we have Philip Morris, PM. With this one, somewhat similar. We just went through an earnings announcement, did not have a call, but this is a stock that's been working its way up, not a well-received earnings announcement. This is a risk of owning shares over an earnings announcement. This one didn't go our way, and it's starting to fall. So, or starting, boy, it's been falling quite a bit. So the trader, again, might need to make a decision. Do we think this is going to go into recovery mode, in which case maybe we retain shares and sell a call higher? Or maybe the trader says, well, we've broken horizontal support. Maybe they also can conclude it seems like there's been a diagonal. Let me cancel that. Let's get our trend line here. A diagonal support that's been broken. Let's just close this one up. Sometimes it doesn't work. So going to our PM, let's right click, create a closing order, and just sell that one. I'm going to sell 100 shares. I'm going to select a market order for this example. Market order just means, say, we're willing to accept whatever the market offers. It doesn't mean that we're going to get this price that we're seeing on the screen. Maybe more than that, it may be less than that, but let's click confirm and send. I'm going to sell 100 shares of PM at the market price. There's not a commission on this trade, but there can be, as we've already seen, on some types of trades. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. Paul says, never let a loser run. I can't say never. I don't say always. I don't use words like guarantee and things like that because there can be exceptions, right? But some of the biggest losses that I have personally witnessed are those where a trader just says it's going to come back. It's going to come back, and it's going to come back. And they just, the phrase is throw good money after bad. Yep, that can happen. That can lead to big losses. So here we're just going to admit, all right, they don't all work out. Done with that one. So that one we sold for 155. Done with the with that PM trade. With Tesla, I think with this one, this is the last one where we need to do something with it. So with Tesla, we have 100 shares. We were waiting for an earnings announcement. That earnings has concluded. There was initially a downside gap, but it started to move higher again. So with this one, you can see we purchased the shares all the way down here. They rallied up. They've kind of been moving into maybe a triangle, but we've already collected an $863 profit on this call, a $995 profit on that call, a $249 profit on that call. Plus, we have share appreciation. That's a nice combination of factors. So in this case, how about we look up here? Let's retain the shares. We're past the earnings. Maybe could we sell a call up here at 360 or probably above 350, maybe 360, possibly 370? Let's go have a look. Let's go to our trade tab. I'm going to try to go for the shortest period first, sticking with the monthly expirations. There's nothing inherently wrong with the weeklies. They just tend to not be quite as liquid. Let's go to the 15th of August and look up there at the 350, 360, 370. All right. Looks like we could get maybe around $6 for 350, maybe around $4 for 360. Go even further. Let's crank out the number of strikes here. We're only seeing 30 of them. Let's change that to 40. The 370, the trader might even get $260-ish for that. How about, what do you think? So a trader could sell a closer strike, get a larger premium, but obligate themselves to sell shares potentially at a lower price, or sell a more distant strike and give themselves more cushion to the upside, more wiggle room to the upside, but at the cost of maybe a smaller premium. I think I'm going to go up all the way up here to the 370 as our example for this one. Let's go to our trade tab. We just have 100 shares of Tesla. So let's go to the 370, smaller premium. I'm going to click on that bid price. This is for one contract of the 370 calls. Looks like our natural is at 264. I'm going to say we're even willing to settle for 260. Doing this, again, in the interest of trying to get a fill a little bit faster. With limit orders, there's never a guarantee that we'll fill. So we're going to sell that 370 call, see if we can get $2.60 for it. There is a commission to be paid here. That'll chip into that. Instead of $260 as a minimum, that takes us down to $259.35. And let's send that off. Okay. Now, Gary says, what are suggested put and call deltas for wheel? We don't make suggestions, Gary. We weigh the pros and the cons of different options and then leave it to the traders to decide. So if the individual trader knows the pros and cons of each, let's say, delta or strike selection, and they can make a decision for themselves if they're going to be using wheel strategies at all, then I've done my job as an educator. I am not an advisor who makes suggestions, though. Okay, good question. But we're in that trade, done with that one. So what's left? We have Visa and we have Walmart. Walmart is just our trade we put on last week. It's just a covered call where we have the preference for the stock to go up but to stay below 100. Right now it's at 97 and change. It's doing just what we would hope. And with Visa, these are 100 shares, but earnings announcement right around the corner. So we're not going to sell a covered call just yet on this one. This is the product of selling a put earlier. We were assigned the shares, and those shares have increased in value. So assignment's not always necessarily a bad thing. We collected the premium. We actually did it twice. And on the second one, that's the one where we were assigned the shares, but assigned those shares, I think at 325. I can't remember. We could go to our account statement history. Let's see, that's Visa. Let's look back. History here. Yep, it was the 325. No, it was the 330 that was assigned. Okay. Oh, and I say that right here. Yeah, we sold the 330. Okay, have to read my own notes. In any case, yeah, this one we just own 100 shares, but we're not going to sell the call. So that's it for our current positions. Let's go take a look at what's going on with the markets. I don't want to take much time with this because I don't think I have any revelations for anybody watching. What's going on? Oh, we have a little tiny red candle here. We're down 0.15% after the strongest bear market recovery in history. But let's just maybe get something that some traders might be paying attention to, even within this nice expansionary phase in the markets. There's been an acceleration of that bullishness just recently. What might this look like? This might look like a bull flag that we've just recently broken out from. So maybe that's an indication that we're likely to go higher. That's one technical assumption. Assumptions sometimes are proven wrong. But let's just say that our trader likes the way things are going. They're going to continue with bullish income strategies that are much like the topic of this series, covered calls and short puts. But maybe they want to use a combination of both. And that's exactly what the wheel strategy is. Just like the name suggests, it's an income strategy where we start the wheels turning. We're looking for a cycle of income. That's what the trader is looking for. And it starts by selling a put option. So let's just say that we're going to put into action a bullish wheel strategy. And it starts with selling a put. So I'm going to go grab an example stock. I already looked for one before the webcast started, just so I'd be ready. But that's going to raise the natural question, how did you pick it? So yeah, I'll talk about that. But how about for this one? Let's use Nvidia as an initial example, although I might bring in another one and let you guys pick between the two. But when a trader is about to initiate this option strategy for income that is bullish and built on options, what might be a pre-qualifier for the sorts of stocks that a trader might use for the wheel strategy? Well, wheel strategy begins as a short put. It can certainly potentially progress to long stock ownership and into a covered call. So long stock ownership is a very bullish strategy. And as a result, the trader may want to make sure that they're doing this strategy on the sorts of stocks that they don't mind owning. So really, the way that a trader might look at this is to think, what kind of stock would I not mind having present in my portfolio? And there could be a number of reasons for being okay with stock investment. It might be that stock is in a sector that the trader thinks is looking good, or maybe they don't have representation from that sector in their portfolio. Maybe the company has fundamentals that are important to that trader. Maybe they could be growth fundamentals like strong revenue increases or wide profit margins, that sort of a thing. Or maybe it's more value oriented. Maybe they've looked at a PE or a PEG ratio, looking for indications of value. But those sorts of pre-qualifiers may be a consideration. That can vary from one trader to the next. Now, there are other potential motivations that can include, these tend to be maybe a little bit more universal, specifically for those that are about to trade options on these things, bullish option strategies. With options, there can be some liquidity issues. If you have an illiquid stock, a low volume stock, it tends to have even worse liquidity for its options, and that can cause pricing issues. Wide spreads between the bid and the ask price makes it difficult to get in and difficult to get out, and make it harder to trade those things profitably. So liquidity can be a concern or a prerequisite. Lots of trading volume. Price per share can certainly be a consideration because stock ownership comes at a price. So for some traders, price is a consideration. How much can I afford if I'm going to be ultimately buying or trading 100 shares or 200 shares or 300 shares of this stock? And then also volatility. Is the stock super volatile and it's going to give me heartburn while I'm trying to collect income? And finally, what's going on with the chart? For some traders, if they're about to do a bullish strategy, maybe they want to make sure that the stock at least looks bullish on the chart. So those are some of the elements that went into consideration for the selection of Nvidia today, right? But primarily, Price was a consideration. Liquidity was a consideration. And look what's going on with the chart. This is a stock that's really had a nice head of steam. It's been running higher and higher and higher. And just recently, it's pulled down and has started to climb again. And for some traders, that sort of a behavior where we fall back and then bounce higher, that's actually a time when some traders prefer to initiate a bullish strategy. And these strategies that we're going to be doing today are bullish. So we have that sort of a bounce, just as an example today. Now, maybe if we have time, I'll introduce another stock that's a different view, where there's a more recently a breakout, a push through a resistance. So we have our stock. We have what the trader might look for on a chart to signal it's maybe time to enter. Now let's talk about the strategy itself. So if you've never heard of the wheel strategy, here's what it is. We're going to sell a put to start things off. That put will either ultimately be assigned, or we will close it out, or maybe it just expires worthless. But bottom line, it's either going to get assigned at some point or it's not. If it gets assigned, what that means is someone executed their right to assign shares to us, sell shares to us at a specified price. That means that we wind up owning the shares. If the trader owns the shares, what might they do with that then? So started the wheel turning by collecting a premium for selling the put. Shares are assigned. What can we do then as share owners? We can sell a call against that if the trader is comfortable with that sort of a strategy. If we sell those shares, now we have the potential obligation to sell the stock. And if that gets assigned, we wind up selling shares, and that gets us back to cash. And what might we do then? Sell another cash secured put. Yeah, so that's your wheel. That's the strategy. All along the way, the emphasis is for many traders collecting income. So with Nvidia, let's go sell a put. So now, which put might the trader sell? I've already given some general, sort of vague guidelines, but one thing the trader might have to determine is how much time are we going to sell into this contract? Second consideration is which specific strike price might we choose, going to the question about deltas. So how much time? Well, when a trader is selling an option, there's sort of a trade-off that they're attempting to accomplish. What they're looking for are great big premiums. Income is the motivation for this trade. Well, we can get great big premiums, but not typically really close to expiration, especially not if we're selling out of the money. So selecting time frames, the ideal trade would be to sell a great big fat premium that's expiring 2 minutes from now and it's way out of the money, almost no chance of assignment. That sort of thing doesn't exist. When we go for very short-term contracts, they tend to be small premiums. So the trader might look out for longer-term contracts to try to get larger premiums, but obviously a longer-term contract has more time to misbehave. So there's the trade-off. So for some, they might find sort of a sweet spot between somewhere, 20 to 40, 20 to 50 days. Sometimes they can go under 20, sometimes go longer than 50, as we've already done today. But yeah, that might be where some find a comfort zone for striking a balance between those considerations. So let's look at the 15th of August first. Let's look at the 15th of August as our potential expiration is a little bit under 20. Now in this case, we just don't have a monthly expiration that happens to fall, inside of 20 to 50. We can either go a little bit long or a little bit short, or maybe we could just choose a weekly. Nothing, again, inherently wrong with weeklies. They're just not quite as liquid typically. So I want to look at this one first. Let's look down here. And as we're selling a put, let's use delta as our guide, since somebody asked a question about delta. What does delta tell the trader? It can tell us a couple of important things. Number one is it can tell us how much the contract might move in price as the stock moves in price. So a dollar move up or down might result in a change in value to the contract of the delta amount. So For example, if we were to look at this 170 delta and we sell that put, if the stock goes up $1, the put might lose 31 cents in value. If the stock goes down $1, this put might gain 31 cents in value, an unrealized gain. Now, that's one use of delta. Another use of delta is that it gives us an approximate likelihood that a contract expires in the money. What we're looking for here is for the contract to expire out of the money. So if I have a delta of 30, that means there's about a 30% mathematical chance that the contract will expire in the money, or a 70% chance that this contract expires out of the money, it expires worthless, and the premium collected is then retained by the seller. So that is going to be the use that we have. And how about we just stick with this one? If we sell that 170, let's put that on the chart. So we're literally considering selling this one for that many days. Selling right here, carrying it through August 15th. So what the trader needs to understand is if we do choose to sell that contract, we're getting into it's a contractual obligation where someone is paying us, looks like between $253 and $255, somewhere in that range. That's for the well, they're paying us, let's just call it 255, just a nice round number. If we collect 255, we then have an obligation to potentially buy shares from someone else. Someone has the right to sell shares to us for $170 per share. If the stock continues rising, what happens to the likelihood that they ever decide to actually sell us the shares? They're sitting on these super valuable shares that keep climbing in value, but they have the right to sell those shares at $170 to Cameron. Are they going to do it? No, it's not likely. They could if they get a wild hair. Somebody could just say, my shares are worth $180, $190, $200 here, Cameron. You can have them for $170. They're just not likely to do that. So this is actually a bullish strategy. That's actually just what this income trader's initial motivation is. We want this contract to just expire worthless. We're collecting $255-ish dollars, and just crossing our fingers that the trade just expires worthless. That's one potential outcome. Now, what's another possible outcome? Stock could go up. It could pull back. Let's say that it pulls down here. It comes down to this support level right through here. And it's down there at 160, who knows, 166-ish as we hit that August 15th expiration. Well, our trader that we collected a premium, sold a contract to them where they have the right to sell shares to us for 170. What are they going to do at that point? Almost without exception, they're going to exercise that. They're going to assign that contract, require us to buy the shares from us for 170. Those shares are only worth 166. So, oops, we're a little underwater on the shares, but we already have our premium. We now own the shares, and we might sell a call at that point against those shares. So that is the wheel strategy in a nutshell. Now, what the trader does not want to have happen, going up is fine. Coming down a bit, coming down below our strike is fine. This is not fine. Okay? If our shares collapse in value, let's just talk about a really bad scenario. This isn't even worst case, but this is really bad. What if the shares fall down to 130? During the contractual period where we have the obligation to buy the shares for 170. Ooh, they're only worth 130. The owner of the contract assigns their right to sell shares to us for 170. Ouch. They're only worth 130. And yeah, we could then start selling calls against this, but it's not going to help very much. This is where the wheel gets stuck in a rut. This is not what we want. So the trader might want to evaluate things. If the stock is really falling sharply, consider buying the put back, or if assigned, maybe just sell the shares. All right. So there we go. Let's go ahead and set that wheel in motion, though. We're going to go to that 170. Now, that's my example strike. it's not the only strike that's available. We could have chosen some other strike. What if I wanted more cushion to the downside? You'll notice 170 is here. Let's clean things up a little bit. I'm going to remove this drawing and this one and this one. 170 has some distance from the current price, but not a lot. What if the trader wanted a little bit more wiggle room and maybe they choose to sell the 165? Well, that's taking on an obligation to pay a lower price for the shares. That's actually a more favorable obligation conceptually, but there's less of a premium to be collected there. If we look at the 165, there's about an 81% chance that one expires out of the money versus a 70% chance of the 170, but the premium is significantly lower. It's about $1 lower, and on a $2.50 premium, we're talking about a 40% lower premium. Okay, somebody says, why pick Nvidia, whose implied volatility is only 5%? So talking about the premiums might not be as big as they might be on other stocks or even on Nvidia at other times. Implied volatility is a measure of how volatile the stock is expected to be during the time frame of the contract. For some traders, low volatility means low premium, not interested. Guess what else low volatility means? It means low volatility. It means, again, conceptually, less unpredictability. So there's a trade-off. Taking on an obligation during calmer times, yeah, it comes with lower premiums, but also, at least conceptually, lower risk. So there's the trade-off. So good question. Some traders are totally comfortable selling at lower volatility times. They just like sailing on calmer waters. Now, things can get choppy at any time, but there we go. I hope that was helpful as an explanation. But I'm going to go to that 170. We could have considered other strikes, could have gone for a bigger premium closer to the current price, larger risk of assignment. We could go for a smaller premium at a more distant price, but a lower risk of assignment. So let's go to that 170. And yeah, the observation here is Nvidia's IV is likely to go up. Not a good time to sell options. It's a legitimate observation. I don't want to be dismissive of that because I'll talk about it at times. So yeah, when implied volatility is low, we may need to be prepared that implied volatility could start to spike up. And if it does, that can make exiting a little bit trickier if exiting is what we're seeking to do. Yeah. So legit. Maybe we'll dedicate a more in-depth discussion in the future to that. But let's click on our bid price here and let's set this wheel into motion. I'm going to click the bid. How many contracts do we want to do? This is where the trader needs to decide what their appetite for exposure to assignment is. Since ownership of the shares is a distinct possibility, how many shares might we want to have an obligation to potentially buy? 100 shares is going to be about a $17,000 potential obligation. 200 shares, about a $34,000 obligation. But this is providing about $259-ish at the moment. You notice that premium has been climbing a little bit, probably because the stock has been sagging back a little bit. Puts get more valuable as stocks drop a little bit. In any case, how about we say that we're willing to settle for the original 255 that we discussed. I'm going to set that as my limit, the minimum that we're willing to accept. Let's click confirm and send. Selling just one in this case. That 170 put, 255 is what we're shooting for. There's a 65-cent commission to be paid out of any premium collected, so that will reduce the minimum premium that we would receive to $254.35 if this order fills. And let's send this order off and see. Looks like we got this wheel turning. So here, just restating it one last time, we just got into an example contract through the 15th of August where the trader has the obligation to maybe have to buy shares of stock at $170 per share. In exchange for that, we were paid, what was it, $258? Is that what I saw? I think so. $2.50 and change cents. $259 of reward potential from this put. So from here, if the stock goes up, the likelihood of assignment is diminishing. And if we hit expiration out of the money, maybe we just keep the 258 or whatever we collected. It expires worthless, and we don't own the shares. That's not necessarily a negative outcome. That just means a realized profit on that premium. If the stock falls below 170, that's where the assignment risk really goes up. Still possible to be assigned on an out-of-the-money contract, but if we go down below 170, especially as we hit expiration, we might have to buy the shares at 170, and in that case, the wheel just keeps turning. We might sell a call in the future against that stock ownership. Roger says, do you always start wheel trading with a put? Roger, yeah, that's usually the starting point for a wheel strategy. I mean, we could start with, let's just say buying a stock and selling a call. And if the call gets assigned, then we go to cash. But then the trader might choose to sell a put at that point to keep that income turning. The typical starting point for the strategy is selling the put, though. Yep. All right. Big wheel keeps on turning. That's right. Stay gold. All right, everybody. Thanks for giving me your time today. We're going to be following up on this trade and other trades in future webcasts. If this is your first exposure to the wheel strategy, maybe go to your paper money, sell a put on a stock that you think is likely to rise, but be prepared if it gets assigned. What might the trader do then to keep that income cycle going? There are pros and cons. Obviously, as we've discussed this, we talked through, if this thing collapses, that can expose this trader to significant downside risk. This is not what we want, which is why the trader is looking for maybe a stock that fits the portfolio for other reasons, maybe a stock they don't think is likely to collapse. Maybe they just think that the price is more likely to go generally higher. All right, everybody, I'll let you go enjoy the rest of our webcast through the remainder of the day. We'll reconvene to follow up on this and other trades in this series next Monday, but I have other webcasts throughout the week. We have lots of webcasts all throughout the week. So if you're new to this channel, first of all, make sure that you're subscribed to the channel. You can go down in the lower right-hand corner, click on the subscribe button, and that just, the channel is where we house our previous webcasts. You can find the archives by going to YouTube, look for Trader Talk Schwab Coaching Webcasts, and you can find right there on our homepage, there's our playlists of previous webcasts. If I click on the playlists, I could scroll right on down. Mine for this series is more toward the bottom. So I'm going to scroll down, and it's about 4 lines up from the bottom. There's trading covered calls and short puts. You can see our view full playlist right there. Another thing that the trader might do is just do a keyword search. I've talked about the wheel strategy in the past. So if you want to learn more about the wheel strategy, there's my discussion, Intro to Trading the Options Wheel Strategy for Income. There is Brent's Basics of the Wheel Strategy. Watch that as well. You can join our live streams here. Another suggestion I would make to everybody watching is if you have an account on X, that platform is the best place to connect with your favorite presenters in between these live streams. So you can find Brent there on X at Brent Morris CS. You can find me on X at Cameron May CS. So this is the guy you're looking for. Here's my handle at Cameron May CS. And this is where you can see I can provide more timely updates on what's going on with the markets. You can even see, look at this. Last week was a terrible week for 80s kids, wasn't it? Hulk Hogan and others, unfortunately, passing on. But you can see and give feedback on maybe technical observations on charts. And if you reply to one of my posts, I try to reply right back to you. So it really is the best place to connect with your favorite presenters. All right. Well, Tom says it's an income strategy, not an investment or growth strategy. Could be a combination of both, but typically for wheel strategy traders, yeah, income is the real emphasis. All right, everybody. Thanks for joining me today. Go have a great day. I'll look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.